Hey guys, Max here, and yesterday we had a really nice day for the US markets actually. They rose by quite a lot. The sentiment seemed to be really strong, but we did have a couple of problems emerge. The big one, of course, being over in China. They had their worst day in over a decade the day before yesterday, and then the CCP is now scrambling to try and sort things out because frankly, it's just not looking great for them. So let's just get right into it and start with what literally happened with the markets today. So equities across the board rose, but especially in the US. The S&P 500 rose by over 2.1%. The Nasdaq rose by almost 3%, which was really good. There was strong sentiment all around, and the markets were happy, and so were investors, so they bought in. Now we will get to why that was the case shortly, but firstly, we also saw some strong markets in Europe. The FTSE 100 is up 3% from a trough it had a couple of days ago. The Stoxx 600 is up 4% from that same bottom a couple of days ago as well, so really strong there too. Now just how good was yesterday? Well, it was this good. It was this green. You can see major gains pretty much everywhere except for the energy sector. Tech is very strong as well, especially mega cap strong super dominant companies like Microsoft, Apple, Amazon and Google. Now why are we seeing all of these gains then? Well, for a couple of different reasons. The first is that there are more hints of progress for negotiations between Ukraine and Russia over the war. Now, I have said it before and I will say it again. Huge market moves of hundreds of billions of dollars based on just this news alone is pretty incredibly irrational. Basically, yesterday we saw some rumors from Russia that they may have loosened their demands and they may now just want Ukraine to be a neutral country like Switzerland. That comes from one Russian official. We do, though, need to take that with a major grain of salt. Another Russian official the other day said that the USA must give back Alaska to Russia and pay reparations to the country, which is obviously utterly insane and came out of nowhere. It's not actually even a real demand, so we really shouldn't get caught up by what these officials have to say. It doesn't actually mean much most of the time, and we shouldn't really believe much about this new development either. We have absolutely no idea what's going on behind closed doors in this negotiation, what is actually being said, what the demands and the requests and the requirements from either party really is. All we're hearing is what the politicians in charge of each negotiation want us to hear. Now, supposedly, there are some saying that Ukraine would actually be open to becoming a fully neutral country as a way to end the war and the Russian invasion. Now, at the exact same time, I've also seen others say that this idea was rejected within 30 minutes of even hearing it. So, are you understanding me yet? This is irrational, and market moves based on this news don't make any sense. We really shouldn't be in a position where the markets move hundreds of billions of dollars in either direction based on nothing but hearsay, but it does. Investors love any excuse to get bullish, so they jumped into the markets and pumped prices up. Now, this pump may last another few days. It may even last for a few weeks. The reality is, though, markets are not happy, and it's not really about Russia and Ukraine. As inflation soars, interest rates will be hiked, and markets will continue to decline over the long term. We will have dead cat bounces, we will have bull traps along the way, and we will most likely find ourselves in a major recession within a year or two. So let's try not to get too distracted by really quite small developments about negotiations for a war which doesn't actually change the fundamental problems going on in our economies. Now, another nice bit of news for the markets is that oil prices fell. Now, that has been a very scary thing to talk about recently. Oil prices, we've seen huge spikes coming from this war in Ukraine. Huge inflation has been caused by this already. Gasoline prices have spiked all over the world. They're up about 40% overnight where I am. But once again, oil prices fell for 2 days in a row, which is really nice to see. And we do hope that this trend continues. Yesterday itself, WTI crude oil fell 5% and it's now sitting at $96 a barrel, far lower than it has been over the last couple of weeks, but not exactly still low, still 20% higher than it should be, but progress nonetheless. Hopefully, it's enough to calm everyone down for the meantime. Now, the markets obviously like this news. Less price pressures for inflation, supposedly less interest rate hikes, but to be honest, I doubt that this will actually come to anything. The markets are betting on that right now. They're betting that interest rate hikes are going to be reduced in the future because oil prices are now falling, and that does explain to some extent why stocks are rising on this news, and it also explains why energy companies fell in the US as well, but I don't really buy it. Now, in the world of risk-off assets, what's going on? Well, gold prices fell again another couple of percent. Per ounce, gold is now sitting at $1,925. far lower than the highs of last week and the week before that. And if oil continues to fall, if the Ukrainian war fears continue to ease, we should expect gold prices to fall as well. If not, if the situation in Ukraine escalates, if things get worse, then we should expect them to rise back up again. Either way, I've been building a gold position over the last few months, so I welcome the opportunity to continue to buy into that at a lower price and increase my exposure. Now, bonds also saw prices fall and yields rise. Across the board, 10-year yields are up a few basis points each from yesterday. The US 10-year Treasury is now sitting at 2.16% yield, a very high comparative number, and the German 10-year yield is almost at 0.4%, which is way above the negative territory that it's been in over the last couple of years. Now, why did prices fall and yields rise? Well, investor risk tolerance has increased, it's gotten better, so people want exposure to assets with more potential for growth like equities, so they sold their bonds and bought into equities or crypto, and this is fully expected. This is exactly how markets should be moving. Now, finally, before we move on to China, we'll have a quick look at the crypto markets. Now, as expected, risk on assets are doing well, and crypto is a risk on asset, so markets rose alongside equities. Bitcoin is up 5%, Ethereum is up 6%, they're now sitting at about $40,000 and $2,700 each, so pretty high. Altcoins are also up, though a little bit less than the big boys, between 2 and 4%, smaller gains, but still gains for sure. Really, there's nothing to write home about here regarding the crypto market and this small pump. It's rising for the exact same reason as tech stocks rose. It's just investor sentiment getting a bit better. So money moved around and entered the market and it pushed prices up. This is, however, one more piece of evidence supporting the idea that crypto, the entire market, Bitcoin and Ethereum are altcoins as well. They are risk on assets, not risk off. Finally, China has seen some crazy moves recently. Yesterday, we spoke about the worst single day for Chinese markets in almost 15 years. The collapse was awful, spurred on by the CCP and their regulatory crackdowns rearing their ugly heads again. Fears surrounding China, maybe helping Russia out in the war against Ukraine, came up as well, and there are also just loads of general problems with China's economy. Their property market is in absolute shambles, for example. Now, yesterday we actually saw Chinese markets fall further, but then we saw a major spike and huge gains as the CCP panicked and tried to prop up the markets. Basically, the Communist Party, they realized that they'd killed the markets with their actions. So they turned around and they said that they're not going to attack companies randomly anymore. They're not going to ban foreign IPOs and they're actually going to help them. They vowed to enact policies to help their economy grow as opposed to kill it off like we've seen over the last year. China also literally just started buying up stocks, just going to brokers and buying up Chinese shares at huge amounts to drive prices higher. Now, that is literally textbook market manipulation. It is not sustainable and it's not going to fix the long-term problems anytime soon. There is now actually a very small chance that the CCP actually does change. Maybe overnight they no longer care about their control over tech firms, but frankly, they're an authoritarian state, and if you believe that, you're just a bit naive. The CCP's nature is in control and authority, and that probably didn't change overnight. For anyone who's looking at this pump and wanting to buy into Chinese stocks right now, there is still a huge amount of risk at play. The CCP has attacked these companies before and they will do it again. The old saying comes to mind: fool me once, shame on you; fool me twice, shame on me. Don't be an idiot. Don't jump into the Chinese markets thinking that you're about to get rich. Let them work their own turmoil out. The CCP actively hates you. They actively work against you purely because you are not Chinese. They want you to be poor and they want their wealth for themselves. Don't put your wealth in their control. It's just an awful idea across the board. Even JP Morgan, who has profited hugely off of China's rise over recent decades, has finally admitted that China is uninvestable today. Now, about 6 months ago, I started saying the same things. And if JP Morgan had said the same thing there, then they would have stopped their clients from taking part in a 30% collapse of their indices. Now, we have actually got some fairly big news regarding Saudi Arabia and a potential oil deal going on between different nations that could be the start of the end of the US dollar's position as the world's reserve currency. Something that is definitely worth talking about, but it's a little bit long for this video, and I'm hoping to put out a shorter video covering that topic later today. Right now, as you're watching this, you're probably either waiting to hear what Jerome Powell and the Fed have to say about interest rates, or you've already heard and you're wondering how it's going to affect us. Obviously, this is going to be a really important topic to cover, and we will go far in depth on this tomorrow, explain exactly what the situation is, why it happened, and what we might expect next, so make sure to catch that video. And then just one final thing before we sign off for today, make sure to check out our two other Stoic channels, the politics and the crypto one down below. Both are going to be kicking off full speed in no time at all, so make sure to subscribe to them to make sure you don't miss out when those videos start going live. If you enjoyed this video, then make sure to comment and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.